If I told you that real estate investors can sell a property, avoid paying tens of thousands of dollars in taxes, and still pull cash out tax free, would you believe me? Because that's exactly what smart investors are doing using something called a 1031 exchange. And in this video, I'm going to break it down in a way that actually makes sense. But more importantly, I'm going to show you how investors are using this in today's market to scale, pull cash out, and build real wealth over time. At its core, a 1031 exchange is actually pretty simple. It allows you to sell an investment property, reinvest that money into another property, and defer paying capital gain taxes. So instead of taking a big tax hit and losing a chunk of your profit, you keep that money working for you in the next deal. Now, there are a few rules that matter. The property has to be an investment property. You have a limited time to identify your next deal, and you also have a deadline to close on it. But the biggest rule, and the one that gets people in trouble, is that you can't touch that money. It has to go through a third party called a qualified intermediary, or the entire exchange becomes taxable. Now, here's where things start to get misunderstood. A lot of people think that if they don't reinvest everything, the whole deal falls apart, but that's not actually true. What really happens is this. If you keep some of the money or you reduce your debt, that portion becomes taxable, and that's what's called BRRRR. So let's say you walk away with $50,000 from the sale. You're not getting taxed on the entire transaction, just that $50,000. Same idea if you take on less debt in the new property. So if your goal is to fully defer taxes, the mindset should be simple. You want to move into a property of equal or greater value, reinvest all of your equity, and keep your leverage at least the same. That's how you stay fully protected. Now, before we go deeper into how investors actually use this to build wealth, quick disclaimer. I'm not a CPA, and this isn't tax advice. I always recommend speaking with a qualified tax professional about your specific situation. But I do work with investors, and I see how these strategies are used in the real world. So let's get into that. Here's where things really start to separate beginners from experienced investors. Most people think that the 1031 exchange is the end of the strategy, but in reality, it's just the beginning. What investors do next is they refinance. So they sell a property, roll the equity into a bigger deal using a 1031. They improve the property, increase rents, stabilize it, and then they go back to the bank. Now here's the key part. When you refinance and pull cash out, that money is not taxed because it's not income, it's a loan. So think about what just happened. They avoided paying taxes on the sale. They moved into a stronger asset, and then they still pulled money out to go invest again. That's how portfolios start to grow faster. Now, once you understand that foundation, there are a few strategies that take this to another level. One of them is something called a reverse 1031 exchange. This comes into play when a great deal shows up before you're ready to sell your current property. Instead of missing the opportunity, this strategy allows you to actually buy first and sell later. There's a structure behind it that holds the property temporarily, but the key advantage is simple. You don't lose deals just because your timing isn't perfect. Another strategy you'll hear experienced investors talk about is combining this with the BRRRR method. That's where they buy a property that needs work, fix it up, rent it out, and then refinance it. What makes it powerful is what happens next. Once the property grows in value, they can sell it and use 1031 exchange to move into something even bigger. So they force appreciation, pulled money out along the way, and still avoided taxes when they scaled up. That's how smaller deals turn into large assets over time. And then there's one strategy that's becoming extremely popular right now, using a 1031 exchange to build a portfolio instead of just buying one property. Instead of trading into a single deal, investors will spread that equity across multiple properties using DSCR loans. These loans are based on the property income, not your personal income. So what that does is it removes one of the biggest bottlenecks for investors. Now, they can scale faster, acquire multiple properties, and continue growing without being limited the same way traditional financing will limit them. Even though this strategy is powerful, it's also very easy to mess up if you're not prepared. One of the biggest mistakes is simply missing deadlines. Once the 45-day window passes to identify your next property, there's no going back. Another issue I see is people accidentally touching the money, not realizing that even briefly having control of those funds can disqualify the exchange entirely. I also see investors trade into cheaper properties thinking they're still protected, not realizing that the difference becomes taxable. And then there's the debt piece. If you reduce your loan amount too much, that gap can also trigger taxes. But honestly, the biggest mistake isn't any of those. It's not planning ahead. Most failed exchanges happen because people wait until after they sell to figure out everything. By then, the clock is already working against them. When you zoom out, this is why 1031 exchanges are such powerful tools. They allow investors to keep upgrading, to keep moving their equity into stronger assets, and to continue building without constantly losing money to taxes along the way. And over time, that adds up. What starts as one property can turn into multiple, and even eventually into a full portfolio. And in some cases, if those properties are held long-term, they can also even be passed down with a stepped-up basis, potentially eliminating those deferred taxes altogether. If you're thinking about selling an investment property, or you're trying to figure out how to grow a portfolio the right way, this is something you want to understand before making the move. If you have questions about your situation, feel free to drop a comment below or reach out directly. And if you found this video helpful, make sure you like, subscribe, and share with anybody that could use this information. Once again, thank you for tuning in to Francisco's Key Insights. I'll see you next time.